Hey there, traders and investors. Todd Gordon. What's going on? Happy end of year. Happy holidays. I thought I would take some time, look at the bigger picture market. Nasdaq Composite just broke 20,000. Give you a long-term view of the market. Couple quick things we are launching. Before we jump in, we're launching what we call an active opportunities portfolio at the Wealth Management Inside Edge Capital, which is active portfolio management. We're going to have some option positions in there, hedges, call writing, et cetera, and a little bit more sort of an active quick speedboat portfolio that would complement the other three main portfolios at Inside Edge. So if that's something that you're interested in, reach out to us, info@Inside Edge Capital, and we will certainly talk to you and see how it fits in your overall portfolio. But other than that, all is well. We're crushing trading analysis on the research business, and that is just me in the market every single day, working hard, watching what's going on, using that as research, feet in the ground, to run the longer term portfolios at Inside Edge. It's weird as I'm getting older as a portfolio manager. My habits of waking up first thing in the morning and checking the futures and watching the markets tick and trade and watching how the relationships are and the rotation and how macro impacts and how the news flow impacts the market. Like nothing changes as I'm getting older. I'm going to be 46 here coming up on Groundhog's Day. So all good. But I just want to look at the market longer term. And this is an Elliott wave, pure Elliott wave video. So if that's not your jam and you think it's voodoo and craziness, you definitely want to click off this. So let's jump in. Screen share, number, large monitor. There we go. Okay. So here's the Nasdaq. Nasdaq Composite, right? So this is Nasdaq Comp is not the NDX 100. The NDX 100 is obviously 100 stocks. It's roughly half technology and the rest is other sectors, consumer discretionary, and even staples and healthcare and all that. So the NDX 100 is trading 21,1759. So that's broken 20,000 a while ago. And those of you who know something about trading, this is, when the floor traders in Chicago were there, they were trading the NDX 100 contract along with the SPX contract. This is the Nasdaq Composite. This is thousands of stocks in it. A vast majority of the direction the Nasdaq Comp gets are from the 100 stocks within the 100, but it has thousands of other much smaller cap stocks in there. So it's going to be slightly different. So the Nasdaq Comp here on Wednesday after CPI is trading 20,039. So just give you the context. And part of the reason I use the Nasdaq Comp for our research customers is there's more history in the comp. The Nasdaq Comp was launched before the NDX 100, which is like, I think, 1985, 1996. This was launched 10 years earlier. And then, of course, before that, the S&P 500 was launched in like the 1950s, and then the Dow goes way back. So the idea is you're looking at longer-term counts. You want to superimpose what's happened in those longer-dated index on top of something that's going on in the new index, right? And that's something that you kind of have to do with stock issues that come to market, right? Longer conversation, but stock IPOs 10 years ago, and you have a 5-wave count, is that the end of the stock? No, it fits within the context of what the broader averages in the economy was doing. So just a longer term discussion on that. So for purposes of this video, I want to look at the Nasdaq 100 from the post 2000 tech crash up to leading into the housing crisis, GFC, which is down to 2009. And as I fill in, some wave degrees, let's just look at what's happening within the channel post 2009 GFC. First thing I want to do is look at fib extensions. Okay. I want to look at the tech crash 2000 to 2002. And one of the favorite fib relationships that I like to use is, when a market breaks through the 618 retracement. So we rally up, 618 retracement was the high heading into GFC. We went down, tested 618 again, broke above, used as support. And actually, it's interesting, the 786, which is the square root of 618, didn't do anything. It usually gets more of a response. But generally, I find that some spectacular reversals pending a stop run move through 618 exhaust themselves at 786 and you get a drop. So some pretty good reversals happen there. However, if 786 doesn't break, I really like to, one, assume that we're going to go to new high, to the prior high, which is 100% retracement. And then once you get through 100%, you go to the 1272. Okay, 1272 is the square root of the golden ratio, 1.618, where 786 is the square root of the inverse of the golden ratio, 0.618. You can do that in a calculator and see. So a really good relationship, okay? So what's happened? We got up to 1272, and then in 2018, when we started, Fed was raising rates, started to raise rates, moved up, head into COVID, that's all 1272. Since then, we've gone up to the 1618, didn't really do much with the 1618, and we have the 200% coming above us, okay? So just kind of showing you some levels there. Within this move, following the 2000 tech implosion, I think we have wave one, wave two, into the 2009 GFC low, and all of this was wave three heading into COVID, okay? Within that, I think the 2022 inflationary value rotation sell-off was all of wave four, okay? Now, if we just look at what was the fib relationship of 3v1, just go down here, we look at 3v1, we got to a pretty extreme level, which is the 2.618. So you take the distance traveled in wave one, which was 158%. If you multiply 158% by 2.618, that is going to give you this level right here. And just to show you again, so again, wave one was 158%. 158% move is going to be to the 100%. See on the cursor there in the box, it says 158%. That's the 100% right there, okay? 1618 is key, 200% is important. Well, we went all the way up to 2618, and then we sold off in wave four, okay? Fine. So next thing I want to do is I want to do a wave 4 verse 2 and just see what kind of relationships we have here. So wave 4 was actually quite shallow. It was a 618 relationship of 4v2. Now I think we're in wave 5. Okay. Now you can't say, based on discussion I had earlier, wave 5 of 5, I've got painted here, tech market's going to crash. No, this comp, I've got data back to 1970. Of course, the S&P was trading decades before that, and the Dow was trading decades before that. So, there's higher degree averages or longer dated averages of say that will superimpose on that and help give you clarity as to where this is going to go. For our intents and purposes, we want to just focus on how far this wave 5 can go up that began back in 2002. All right. So, first thing that we want to look at is I want to do a wave 5 study. Let me just clear that off. Ratio analysis. First thing I want to do is 5 verse 1 plus 3. And I'm going to clear everything and just kind of show you how to do this step by step. So first thing you want to do is wave 5 verse 1 plus 3. And what you're looking to do is find clustering. The blue labels are shallow. The green are typical for that Fibonacci study within the series. So this is what we're doing is we're taking net distance traveled of 1 through 3, projecting up from 4, 38% in 618. Okay, lines, and I've got that pinned. Next one, I'm going to go ratio analysis, come here, 5 plus 3v1. Okay, that one really doesn't help. And what this one does is all of wave 1 multiplied by your fib ratios projected up from 2 to get where wave 5 goes. This one is significantly higher, so that one's not going to do too much for us, okay? So I'm going to go on to the next one, which is 5v1. Okay, now, percent distance traveled in 1, which is 158%, right? We already did that a couple times. A very good relationship in a 5-wave motive pattern is if wave 3 is extended, which it clearly is because it was 2.618 to 1, you would expect the distance of 1 to be approximately equal to that in 5. So another 158% would get you right to that green. That's why it's color-coded green at the 100%, 26,043. All right, so I'm going to pin that. Next thing, we're going to highlight this, ratio analysis. Let's do 5v4. Okay, now this is an external retracement, or what we call an extension of wave 4 down. Same concept, okay? And I'm gonna go off of this monthly down to the weekly, get a better view of this, okay? When you break the 786, which was right here at 14,647, that high, we sold off, came back to it, you're expecting a move up to the 1272, which was at 18,404, which is right there. Well, now we're through that. We have 1618 and we have 200%. Okay, so I'm just going to get rid of those for clarity. All right. Now, so what does that mean? Well, we have a pretty good zone at this significant high of wave 5 into, I would say, a beginning at 21,000, but then you've got 3 levels here, 26 up to 28,000 long term in the Nasdaq before I would say we have significant resistance. Okay, so let me just highlight that. Okay, I'll get rid of this guy. It's kind of out in the zone. All right, so that's fine. Let's go inside of red 5. Of course, you're going to need 5 smaller waves. All right. So as we break this down even further, you know, I'm going to bring 2 smaller degrees in here. And this is the idea of Elliott being fractal in that, you know, we're starting in very high time frames and we're drilling down into smaller and smaller time frames using the wave model. Okay. So what I think is happening here from the 2022 lows, I think it was diagonal 1 up at the intermediate degree, complex WXY down in 2, and then we did 1, A, B, C running flat, which sets up green 3, which is what we're doing right now. Okay, so as we're starting to get into a little bit more relevant time frames that take us into next year, I do think we're inside of a 3rd wave. Okay, and I'm going to be moving stuff around. As I said, this is heavy Elliott wave right now. So if we do blue 1 and blue 3, ratio analysis blue 1 and 3, 3v1, okay, what do we have? We've got the 1618 here, and we have the 200% here. And don't forget this highlighted zone that we built from the higher degree. That's starting to fill in, okay? So within blue 1, I've got diagonal up in 1, WXY in 2. And then this has been quite confusing in 23 and 24. The best way to count this is not calling all of this 1 because it really leaves a 3-wave move in its track, which is not accurate. Okay, you need to have trend waves 1, 3, and 5 break down into 5 smaller waves. And as we stretch it out a little bit, that's going to be the best way to get 5 out of 1, A, B, C. And now, guys, what's interesting is I think we're inside of wave red 3 of blue 3. Oh, sorry, red 3 of green 3 of blue 3. Right, so we kind of have a market model to unfold that takes us into the next 2 years, right? So what's interesting now is, you know, if we look at green 3, let me just get this out of the way. If we look at green 3, same thing, 3v1, we're right at the 100%. So what that means is percent distance traveled in 1, projected up from the end of 2. Equality is at 20,711. We're at 20,304. So we're only 40 points away from the 100% projection of green 1 and green 3 that began back here in October of 23. If this breaks and we don't hold resistance, I'm thinking the 1618 at 24,570 is going to come into play, right? So now we're starting to sort of build out this upper zone just a little bit more, which I'm thinking might look like that. Okay, the 1618 of blue is down here, but the 200% is inside of that zone. So I'm almost wondering if into, you know, I'll go down to a daily now. I'm wondering if this is wave 3 of 3, setback maybe ahead of Trump or right after Trump takes office, move up into 3, start to sell off into the summer of 25 and 4, then go up to the ultimate target that completes green 5 of blue 3, which that blue 3, and I know you probably lost the context, but that blue 3 goes all the way back to the 2022 lows. So it'd be 1, 2, 3, sell off in 4, and then we go up in 5 of 5, and that's significantly higher from here. So just to put some percentages on that, so from current levels, maybe we go up in 3, down in 4, up in 5 of 3. So from here until we start getting into resistance, we have 16, 18, 20%, until we start getting into resistance. Then if we can get up there, then a drop, mid 2025. And then I would say maybe we mount another attack at the end of 25 into 26, like that. Okay. So does this have to work like this? No, not at all. This is, a one path forward. There are multiple possibilities of analysis and projecting the future like we're doing. All analysis is subjective. It doesn't matter what it is. If you're doing macro or rates, higher rates, lower rates, what's good? Trend lines. How do you draw trend lines? There's all analysis is subjective, but the important thing is to have a game plan. And when the game plan unfolds in front of you, you press your bet and you increase your size and you increase return for your investors. But when things don't go right, and things start to change, that's when you have a backup alternate plan B, alternate plan C, and you quickly, calmly, unemotionally go and course correct and get on the right track. So that's what we're looking at. So anyways, really, really good year with a little over 2 weeks to go here at Inside Edge Capital and trading analysis. A really, really good year. So the combination of financial planning to know exactly where your risk buckets are in your various accounts need to be planned out. You got to have everything set. That's why financial planning is so important on the planning side of Inside Edge Capital. And that's why I hired an amazing guy who heads up that department, and then I'm focused on the portfolio side. And combination of good planning gives you confidence and the ability to go and see your trading or investment plan through to its full potential, right? Because until you've really accepted what your risk parameters are and you've accounted for what this account means and the duration, longevity of how long this money expects, when you're going to need that money, until you answer those questions, you can't be at peace and, at ease with the money you have at risk in the market. And if you're if you're not confident in it, you're going to cut your trade plan short. You're going to take your losers too quick when they ultimately would have won. You would have taken your profits too quick instead of seeing your trade plan through to completion. And, Elliott for me is just one of many tools that I use to trade and invest in the markets. But, for me, it just creates a framework and boundaries and parameters that I expect things to unfold within. And if it doesn't, course correct. Nothing's perfect, and we get on the right side of the market. So hopefully that helps, guys. All right. Have a happy end of the new year if I don't get another free video out, and I hope you had a great 2024, and here's going to be an awesome 2025. See you guys. Take care. Hi, it's Todd from tradinganalysis.com. Thanks so much for watching. Listen, my team and I have so much to share with you in terms of our technical analysis or fundamental analysis, portfolio management tactics, trading in and out, maybe options, sector rotation. Let us know what's most interesting to you. Maybe drop that in the comments section and we'll do our best to work it in. Also, consider clicking the subscribe button and the bell icon to be notified when we put out new videos. And finally, you can check us out at tradinganalysis.com if you'd like to see us manage our real portfolios in real time. Thanks again for watching.